Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and of course, crystal ball gazing. Today is Friday, November 8th, 2024. Today's episode, I wanted to start talking about Fed Powell's FOMC speech. I found it to be fairly neutral and, data dependent. He purposefully seemed to just be like stone cold, about everything. As I had been saying, I was sort of wondering if he was trying to be, more neutral or more like hiding some things before the election to not like rock people's expectations or anything like that, and maybe he'd let out a few more of his ideas, but he gave the impression of just being totally solid and confident that he believes that unemployment is not a problem while inflation is still coming down. So it wasn't really nothing very groundbreaking. I think one thing he mentioned that I did find interesting was someone called him out on the questions about the quote that I bring up all the time. I remember from the first 50 basis point cut in that meeting, how he said specifically, further cooling in the labor market is not welcome. And he said it with this like really dark tone, as if to say that like he was like worried about it. And that along with a 50 basis point cut got markets thinking like, uh-oh, what's coming? And now that was addressed here, and he pretty much just said that we've been lucky, I think, to not have further coolness in the labor market with inflation coming down. A lot of times when you have disinflation or deflation, that is accompanied by losses in jobs and higher unemployment. And he seemed happy about it seeming like everything's fine for now. There was a few hints in this speech and for what he's saying that like gave me the impression that he doesn't fully believe what he's saying. That like, it's a business cycle, guys. Like, there's no such thing as not missing the downside of a business cycle. Things go up and they go down. But anyway, I finally watched the whole thing with all the questions, and that's my take on it. Next thing for today's episode, I just want to bring up that credit spreads again. I've been bringing them up a lot lately, and I'm going to keep bringing them up, I guess, as long as they remain interesting. Credit spreads are super insanely tight is how I would describe it at this point, and I am currently betting that they will spread. If you've been following the show, you know that I own a fair amount of my portfolio in the value of the put contracts themselves. So it's about 2% of my entire portfolio. So it gives the exposure of almost double or triple the size of my portfolio, of the amount of stock that it's basically sort of shorting, with the premium and the time and all that. But anyway, just to bring it up, the Fred website, high yield corporate bond spread, the spread that lower grade investment, not non-investment grade bonds, junk bonds. These are called junk bonds because they have a pretty bad reputation for missing payments and going bankrupt. And when the spread is really thin, it means that people are willing to take on more risk for a smaller amount of extra yield on the bonds that they're buying. And so when it's super tight, it means that the market thinks that junk bonds are just, they're safer than they used to be. They're safer than they normally are. This is saying explicitly that they think that the economy is just like 100% strong. Everything is perfectly fine. And it's these moments when things tend to fall apart. Again, if you go throughout history, The last rating of this ridiculously low level, 2.73% spread. The last time let's go through the lows here. So we saw in beginning of 1997, 2.73. Okay, and then we drifted around in this area for a little while. We even got a low of 2.59 for two periods there, August and September of 97 at 2.59 before we finally spread significantly to a much wider yield of 6%, sending the value of junk bonds much lower. This is why I own puts on HYG. It seems, the spreads, they can't stay super tight forever. It's not really possible. That's why they're junk bonds. They will go bankrupt. They will default on their payments. That's what makes them junk bonds. They're higher risk. And so when we're pricing zero risk and people are buying them, that's not the right time to get junk bonds. And it's a great time to short junk bonds in my strong estimation. And then from that period, 1998, we got all the way up to 10%, staying around there, around the dot-com bust. And then things were honky-dory again right after the dot-com bust, going all the way down to a spread of only 2.83 in February of 2025. That's higher still than where we are right now, by the way. Jumped up to 4%, and then trickled down to an ultimate low of 2.46 right before. This is amazing. I bring this up a lot, but think about this for a moment. People are purchasing junk bonds in May of 2007 with only a 2.46 spread between those junk bonds and treasury bonds. All right. The market was 100% confident that the economy was stronger than ever, that they could, buy these junk bonds and just get a little bit more yield for, letting their neighbor borrow their money instead of, the treasury. And what happens? Well, it's not hard to see what happens when credit spreads get unbelievably tight. They widen, and in the Great Financial Crisis, we peaked at a 20% difference between the yields of junk bonds and treasury bonds. And before subsiding, again, 4, 3, 5, 3 to 7% seems like a normal range. 2 below 3 is insanely tight. And not only do we have insanely tight spreads on junk bonds, even Doublea bonds, which can range in the spread between themselves and treasury bonds. It wouldn't be abnormal to be around 1%. And we are currently below 0.5% at 0.43%. Again, this happens very, very rarely. In fact, looking through this current chart, we saw that in 1997, and I don't think we've seen that since. Nope. 45, that's a low there. What about in 2018? 53? Nope. 2020? Nope. 53. So we are currently, the current spread between Doublea bonds and treasury bonds right now has never been lower. Is that right? Yeah. Since the 90s, friends. Since 1997, before the dot-com bubble burst. Mr. Market is getting very complacent here, in my strong estimation, where I believe I stand to benefit from seeing this oddity as being odd and, seeing my crystal ball like, it's going to go the other way. Again, best place for me is shorting HYG put contracts. I have them dated over a year out. The tighter these credit spreads get, the more excited I am about the reversal, because, this is the thing. To me, it feels like a spring winding up. Like, we're gonna squeeze every last drop out of these yields before people realize that that the towel's dry and there aren't any drops left. On the daily reminders, no changes. The Fed is still restrictive. All these things, I'm not going to read through them. If you want to see me read through the daily reminders, watch Monday's show. Again, these are daily reminders because I think they are immensely important to have in the back of your mind every day. Every decision that you make, I think, is wise to have with this as like the backdrop of where we are and what's going on in the economy. The crystal ball reading, therefore, remains that the S&P 500 is currently priced like it's a Ponzi scheme, relying solely on other people to purchase it for a higher price than you're purchasing it for, instead of buying something that has clear value to it. When things get to a certain price, it functions like a Ponzi scheme, not an investment. And so I do believe that it is priced currently as a Ponzi scheme, then there's a bear market imminent. I also believe the Fed won't cut fast enough to save the economy. I think once we roll over and things start looking weaker and the Fed has to start catching up, they're going to be very far behind in this cutting cycle due to fiscal dominance and the fear of inflation. We will dive straight into the charts, but before we do so, thank you so much for all the support and the likes. Feel free to support the channel as much as you please. It is greatly appreciated. We'll start with the S&P 500, and guess what, guys? We've made history today. The top of today's wick, we got to, what does it say? You probably can't see it on my screen. It got to 6,012 and 45 cents in the S&P 500. Woo, Mr. Market, you did it. You got to 6,000. Finally, we did it. We got to 6,000. What happens next? I mean, like I've been saying on the show, I watched certain chartists that believe we're actually headed to 6,100 before we roll over, but this could also perhaps be the ultimate top before we roll over. I don't know what Mr. Market's gonna do. The VIX has cooled off. I mean, Mr. Market might drive the price higher, and I don't care. I buy things that I think have a lot of value, which means I buy things that seem very cheap to me. Things that are very cheap have a lot of value. Things that are very expensive do not provide me any value whatsoever. They provide me with extreme speculative risk, is how I would describe it. But go ahead, Mr. Market. Let's see what you can do. Oh, I should have put this in the beginning of the show. I did want to mention this at the main part of the show. The Fed funds futures is shifting a little bit today, very interestingly. This is obviously off of the back of Jerome Powell obviously seeming more hawkish than the market was sort of thinking or expecting. And he did. When all the coldness was like, yeah, we're gonna hold things, and we're on the right path, and we'll do what we need to do as time progresses. Anyway, point is, the December meeting has a now increased probability of no cut. Yesterday it being 23.5%, today being 33.7%. So a 1/3 chance now of no cut in December. Interesting. Very interesting. We have more data coming out before that actual meeting, and so these things can change. They can flip on a dime. We could end up having another 50 basis point priced in if we get data that comes in as showing obvious weakness. But this is a notable update for today anyway. There weren't a whole lot of other charts. I have 3 other charts I want to share for today. The first being TLT. I very accurately, apparently saw this broadening declining wedge, we call it, which after a move down is a signal to actually a reversal signal. And so we are headed straight back up to the top of this little channel thing. Not channel, trend line, the top of the wedge. Not only do we have that as being pretty strong evidence that this is actually a bottom in treasury bonds and that we should be reversing strongly out of this. Huge divergence in the RSI. This is not something to ignore, not at all. This is a major divergence here. As you can see very, very clearly, we have a higher high in the RSI on the same points where we see a lower high in the price. So from this high to this high and a lower high. Not only that, we see a divergence on the lows as well. We have a low, the low here in the price. We have a lower low in the price and a higher low in the RSI. Major reversal signal. This looks like a bottom. And this, if you've been following the show, you know I have like, it's 55% of my portfolio now in versions of TLT. I have ZROZ and TMF, which is a leveraged version of TLT, and ZROZ is similar, has a longer duration, so it's more sensitive to interest rate changes. And as I've been saying on the show, TLT, my favorite place to be. I could not be more confident than I am right now about this. These chart patterns give me a lot of confidence that this is it. But remember, folks, I'm just a guy with a crystal ball. Two other charts that caught my eye today. KWEB, again, this is the Chinese Internet ETF. It holds the Chinese company version of Amazon, Facebook, etc., etc., etc. Apparently, they announced some stimulus, I believe last night, our time in the United States, and apparently it didn't impress anybody. So the KWEB dropped by almost 7%. Now, that seems extreme, except for the fact that, we're nowhere near where we broke out before we went up 40%. And even with today's 7% drop, we're still within range of this coiling up pattern. So this is certainly not looking like a reversal signal to the downside, not yet anyway. Taking this little trend line here, I would guess that we were headed lower out of this if we had another candle closing below the wick of today's candle to the downside. Then yeah, maybe we'll even go back down to this range here. I don't really care. I think, again, Benjamin Graham says, basically don't worry too much about political risk when you own the production of goods and services and it's dirt cheap. Like I've said in the last show as well, politicians don't run the world. Business does. And when you own the business, you own the world, you own the production. And if it's ridiculously cheap, then you're buying yourself a lot of value and potential upside. That's how I see it. I'm looking for KWEB to rise to a more normal low valuation of around $45 to $50 in the value of this fund KWEB. At that point, I would set a trailing stop loss to get out. Last chart of the day, wood. Very interestingly, has been rising recently, and today dropped pretty strongly, 2.36%. I just wanted to bring up this chart because I noticed a pretty darned clear. I mean, how could this not be more clear? It's almost like there's someone literally painting this picture perfect head and shoulders top. So it looks to me like this might be where things are headed. I mean, we finally hit that 6,000 marker in the S&P 500, and with all of the other things going on with where we are in the business cycle, wood may help lead the way down. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.